MarketWrapWithMo.com.
Welcome back, everyone, to Market Wrap. I'm Mo Ansari, president of Compact Asset Management, and you're tuned in as you've been doing so for nearly 2 decades now, and I really appreciate that. I hope I give you information that makes you think. Think outside of the box. That's really the important thing. But today on our guest line is Mr. Robert Prechter, Jr., founder and CEO of Elliot Wave International. Mr. Prechter's firm is recognized as the world's largest independent financial forecasting firm, providing analysis on all major markets worldwide, from intraday monthly timescales via print and on online publications. For his part, Mr. Prechter has also written 13 books, including the New York Times and Wall Street Journal bestseller Conquer the Crash and How You Can Prosper During Deflationary Depression. Mr. Prechter, welcome back to the broadcast.
It's always great to be on your show.
Bob, I appreciate you being on the broadcast today. As you know, and all the listeners know, I subscribe to all of your services at the Elliot Wave Theorist, the Elliot Wave Socionomics, Financial Forecast. I look at all of those reports and in the last couple of days, you did something very interesting in the last week or so. You issued 2 interim reports. Usually we'd get 1 or 2, you issue 1 or 2 of those a year. But all of a sudden, 1 week, you issued 2 or 3 of those. And I was looking at the January issue of the Elliot Wave Theorist, and the biggest down wave ever for financial assets in an environment of runaway deflation. That is the headlines for the January issue. Government is printing so much money, Bob. We are going to, inflate everything, and we are going to go through. That's the conventional wisdom out there. How can we have deflation? Look at the gold market. It was at $1,200 an ounce.
Right, and Mo, you answered this question very well in your introduction. You've been through this many, many times. When you've been in the market for several decades, you know that things run in waves and cycles. Every turn has its time. And when the people came to you and said, real estate never goes down, this is different, or the stock market never goes down, this is different, always had a cover story. And the cover story for deflation, which began in the middle of 2008, is that the Fed is inflating, the government's spending money, how can deflation possibly happen? Virtually everyone, every investor you talk to, most of the advisors you talk to, money managers and so forth, accept this argument. But that is exactly what you get at major turns in a trend. You get people so convinced that the story that they're using to defend the majority opinion, which, as you know, is always a very dicey thing in the market. You'd rather be in the minority than the majority most of the time. To justify that, you always need something that sounds reasonable. Now, I wrote a whole book called Conquer the Crash, and 5 chapters in the middle of that were spent arguing the case for deflation and why all of these inflationary arguments are wrong. What they miss is that the ocean of IOUs, the ocean of credit out there, which is somewhere between $50 and $300 trillion, depending on how you add it up, is much, much bigger than the monetary base. A lot of people have been pointing to the doubling of the monetary base in 2008 and saying, oh, how inflationary that is.
Right.
If they can't lend that money, it's not inflationary, and if the outstanding IOUs are losing value, which certainly happened in many, many mortgages in 2008, it's about to happen again across the board, that is a deflationary force that $1 trillion worth of base money cannot combat. So we are in a deflationary environment. We've had this rebound in 2009, which was reflationary. So you saw the commodities go up, the stock market have a 50% retracement. All of that's completely normal. I think it just ended. That means we're about to start another deflationary wave, just like 2008, but probably even more severe.
Now, that is a lot different, Bob, than what 99% of the people out there are saying and doing. They're saying, look, this is it. It's a cyclical bull market, and now they've come around to the secular bear. They've given up the hold and hope strategy, which I started talking about in 2000, why the buy and hold does not work. I call it the hold and hope strategy. That's what I named it in 2000. And but now we are getting more and more people coming around to that sort of thinking. But what they're doing and what they're saying is different. Now, how can somebody who's listening out there and people say, well, we've got this and we've got that and we do that, how can they differentiate from what people say, for what advisors and brokers say, and what they are going to do, and if they have any expertise in doing that?
Well, we keep about 3 or 4 dozen indicators, and we have indicators not only of what people are saying, such as polls of traders, polls of advisors, money managers, and so on, but we also keep indicators of what people are doing, such as how much cash do the money managers have in their funds, what is the put-call ratio, what's the VIX, and so on. So on occasion, what people say and what they do can differ somewhat, but what we have found for the most part, particularly when you're right at turning points, they agree pretty much across the board, and people are doing what they're saying. And what we have had recently is buying almost across the board, with the exception, I think, mostly of the public. The public has not been in this rally as much as they were before. They're now moving into a lot of bond funds. But as I'm sure we'll touch on in this conversation, I think that's going from the frying pan to the fire. They went from stocks to real estate, and then from real estate back to stocks, and then they're moving to bonds. And every one of these moves is going to make them lose money.
Well, Bob, wait a minute. Bonds are the safest things to buy. I mean, people go out, and I'm, again, playing devil's advocate here. People say, look, I'm sitting in munis, and those are the safest thing. And I get this tax-free money, and how wonderful munis have been. I mean, in '08, they got killed, but besides that, now they're saying, look, munis are wonderful. Why are bonds bad?
One of the most important things that happens in a deflationary environment is that entities that have issued too much debt are unable to pay it. People are moving into munis and corporates now. They think they're safe. They're definitely not. States and municipalities are pretty much broke across the board, and when it comes time to meet interest payments that they can't raise taxes to pay, they'll simply do what they did in the 1930s and default on that debt. So I think people trying to reach for yield here are making a big mistake. They're making 2, 3, 4, 5, 6% if they go out into a junk bond. But unfortunately, I think what's at risk is not the payment; it's the principal. So I am suggesting very, very strongly to anyone who wants to protect his wealth that people move into the safest possible investments on the face of the earth rather than taking any risk. Remember, in 2008, everything went down. Real estate fell. Stocks fell by more than half. Commodities fell across the board. Oil dropped 70-something%. That's what we're facing in 2010. If you're trying to protect yourself in any of these other areas, particularly in these bonds, which, as you remember, the spread in interest rates was tremendous at the end.
I mean,
of 2008.
high yields were giving 21% over Treasuries,
right,
which had never happened in recent 100 years or so. But what about the dollar, Bob? It's going to be worthless pretty soon. That's what the conventional wisdom is. We're printing so many of those. Why should people go out? And I know I got some long dollar positions, but why should people go out and buy dollars?
Well, last time we talked, I was taking a very contrary opinion and saying all of this talk about the death of the dollar and it's going to collapse and it's going to be worthless is a great cover story for one of the greatest buying opportunities in a long, long time in any market. The dollar was as shunned several months ago as gold was when it was trading down at $255 an ounce in 2001. People didn't want it. They could see no argument in favor of buying it. The same thing was going on with the dollar, and now the dollar is leaping, the euro's falling, and I think that is one of the symptoms of a deflationary environment.
I want to thank Mr. Prechter for being with us today. Bob, thank you again for being with us and giving us your thoughts and clarifications and your ideas. Again, it's thinking differently. That's not the conventional wisdom, but in these markets, conventional wisdom is mostly wrong. The majority is always looking left when you should be looking right. And always they're looking on the wrong side. They're looking at the wrong things. By the time it's obvious, it's history.